As the name signifies, Warren Buffett and Michael Burry are two of the most extravagant investors in the market you can look to for some quality advice. Both of them have got investing strategies and philosophies which are widely known throughout the investing world and have got portfolios worth billions and billions of dollars. But there is one stock that brings the bulls close enough to lock their horns. Today we're going to break down their investing strategies so that everyone can have a piece of the golden cake. Buffett and Burry are the top-rated names in investing business. Anyone embarking on a journey to gain financial freedom through investing in the stock market needs to have these pundits as their benchmarks so that they can measure their success. So sit back because we're going to uncover one quality analysis for you guys. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. Buffett and Burry, both are well known for sticking to their investing principles. Now, Warren Buffett is known for sticking to his fundamental value investing, whereas Michael Burry, on the other hand, is famous for calling the dot-com bubble as well as the housing bubble in 2009. This guy warned everyone back then, but the world is a cruel place, nobody listened, and the majority of the investors were responsible for digging their graves. But let's start breaking their philosophies and strategies. To begin with, we have the Oracle of Omaha, which loves to play with stocks. According to Buffett, there are two important drivers which are capable of boosting stocks up. One of them is that the interest rates generally go down and return on equity and businesses have gone up. Now, these are very good points for the stocks to go up. But the problem starts when the very attractive stocks which are doing very good start to draw the attention of other people who literally get excited about the fact that the guy living next door made a lot of money, or they simply missed out on an opportunity to make big money. The action of the market itself captures the attention of more and more of the participants as opposed to the businesses themselves, and that is when you get into dangerous land. Now, this is a thesis given by Warren Buffett just a year before the dot-com bubble peaked and the crash started. He concluded after a year by saying, "I told you so." When you invest with strong foundations and principles and play it for the long run, you are more likely to benefit from the quality businesses you invested in. Now, as we all know, the dot-com bubble started somewhere around 2006, and when we look at the charts of the time between 1996 and 2000, when the bubble peaked and crashed, we can see that the gains for Nasdaq were out of the roof, as it gained over 700. On the other hand, Buffett's Berkshire Hathaway was only at around 69. We all know how the world responded to this. They simply pressured and criticized Buffett for his old and outdated investing approach. They all observed how Berkshire Hathaway was lagging as compared to Nasdaq. They thought that this contrasting gains proved that Buffett's era was now over. But just press the fast forward button from the top of the dot-com bubble from March 2000 to 2007, we can see that the Nasdaq was lying in a bear market, and that too, not for a short time, but for years. It almost shrank half of its value. But on the other hand, there was no bear market for Berkshire Hathaway. And do you know what? From 2000 to 2007, the period after the dot-com bubble and before the housing bubble, Berkshire Hathaway scored gigantic gains of more than 168.5%, while the Nasdaq was down by almost half of its gains since the dot-com bubble took place in 1996. But still today, the Nasdaq is up by over 2,000 points, while Buffett's Berkshire Hathaway is up by 1,400 points. The million-dollar question is the trend taking place again, or will Buffett be proven wrong this time? But one thing's for certain, Buffett is not a market timer. As we have seen, Berkshire Hathaway has taken a hit of more than $30 million on Apple, which we will discuss later on. When we look at the latest moves made by the Oracle of Omaha in its portfolio, according to the latest 13F filing, we can see that Buffett has preferred to open stakes in HP, Paramount, Occidental Petroleum, Citibank, Ally Financial, Mickelson, and Celines. And apart from that, Buffett also added to his stake in Apple, Chevron, Floor & Decor, Activision, Blizzard, and Liberty Media. Buffett also got rid of stocks like ABV, Bristol Myers, and almost the entire stake they held in Verizon. And they also reduced stakes in Royalty Pharma, Store Capital, and Kroger. The game is simple. If the numbers make sense and they are coherent with his investing philosophies, Buffett is going to go for it. When we come to Michael Burry, he is famous for calling the dot-com bubble from 1998 to 2000, as well as the housing bubble from 2007 to 2009. He literally warned back then, but again, people didn't listen. But when they lost their money and Burry was proven right, all eyes turned to him and he became a name among the investment community. So when Burry talks, we need to listen. Importantly, when he warns, we certainly have to listen. The problem is, we're still in a delusion, just like back in those dot-com bubble times, where the market participants think that this time is different, for whatever reason. But Burry came out firing and said the ghosts of the 2008 financial crisis, the one fueled by the housing bubble, are still alive and it's gonna happen again. According to Burry, the inflation problem is here to stay, at least for some years, and we're finally going through the blowback of the devastating policy promulgated by the Federal Reserve almost a decade back. Now, it is going to take a long time for this inflation to go away, and it's not going to go away that easily. Not without aggressive action taken by the Fed. When we look at Michael Burry's portfolio, we can see some interesting moves in his lengthy portfolio. Now, his haters will say that he should try to short as many stocks as possible because he is not good at buying them. But according to the latest 13F filing, he contains stakes in Stellantis, Global Payments, Warner Brothers Discovery, Next Star Media Group, Alphabet, Meta, Cigna, Bristol Myers, Inventive, Booking Holdings, and Sportsman. As we can see, Michael Burry is also not a market timer, as we can see from the 13F filings that his stake in Bookings Holdings is down by 15% in the disaster of Warner Brothers. But the investing world seems to be divided into a single stock, and that is, you guessed it right, the Apple stock. Warren Buffett and Michael Burry both have different stances on Apple stock. Now, Michael Burry is an admirer and a follower of Warren Buffett, but this makes the collision around Apple stock even more interesting. While Buffett likes Apple stock despite losing some $30 million on it, Burry is shorting his stock using put options. Well, investors, think of this stock as the largest stock in the world, so let's dive right into its numbers. According to the latest reports, net sales for Apple went over 1.87 year over year, while the cost of sales went over by 1.93 year over year. And even the operating expenses went over by 15. So this is a bad recipe because you have a company with a growth rate and expenses and the costs are rising higher than the actual revenue rates. Therefore, we see that the net income for Apple is down 10.58%. But despite these conditions, both Buffett and Burry are sticking hard. One thing is for sure, something's gonna happen. While Buffett is known for his value investing principles and Michael Burry for his play long principle, both of them are prodigies with paramount investing wisdom. If you're new to the game and are looking for a place to start learning about stocks the right way, we've given a guide in the description below which explains the 6 stock categories in detail, and these stock categories are each different to analyze. Check out this video we handpicked for you, and we'll see you in the next one.